Welcome, folks, to the latest edition of the What Does It Mean podcast. I'm Chris Versace, and joining me, as always, is Lindsey Bell. We have a extremely timely conversation to share with you all today with Mark Klein, Chairman and CEO of SuRo Capital, and Evan Schlossman, who heads up the AI team over at SuRo Capital. Why is it timely? Well, you've probably seen some of the news out there regarding some major developments on the AI front with DeepSeek, a less than 1 year old AI company out of China, and it's injecting a fresh amount of turbulence, not only into the stock market, but into a number of key companies, NVIDIA, for example, that are thought to be the big beneficiaries of AI spending. And we've had some big AI spending announcements recently with President Trump introducing Stargate. We've also learned that Meta is planning a significant increase in its capital spending in 2025 compared to 2024. So Lindsey and I are extremely thrilled to share this conversation because it brings some much needed context, perspective. And I think when you're done listening to it, you're going to realize that, disruption's a good thing. But on the other hand, that doesn't mean that the folks that were positioned to win aren't going to. So I would encourage you to sit back, listen to our conversation with the folks at SuRo Capital, and stick around for what we share with you when the conversation's over. Hey folks, it is January 27th, and there is a lot going on in the AI space, and I'm really excited, as is Lindsey, to have a special edition of the What Does It Mean podcast. Today we're going to be joined by Mark Klein, the Chairman and CEO of SuRo Capital, trades under the ticker SSSS. It's a publicly traded growth stage venture capital firm that invests in a wide array of areas, but has key positions in AI, consumer, and software investments. Also joining us from SuRo is Evan Schlossman, one of the folks on the team that focuses on AI. Mark, Evan, thank you for joining us today. As I alluded to, it's a big day given what's going on, a lot of disruptive talk on the AI front with DeepSeek. And I just wanted to start our conversation off from gathering your perspective on what is DeepSeek? Is it the disruption that some people are talking about? How are you communicating your thoughts on it to your shareholders? And in other words, help the audience understand what's going on.
So DeepSeek is interesting. It's based on the version 3 of the model from DeepSeek that was released back in December. And then on last week, they released DeepSeek R1, which really takes an interesting approach into how they are training the model. It's taking a more reinforcement-based approach, which has allowed them, based on the varying reports, to basically train and produce a model that is close to what OpenAI's one model is getting in terms of output, maybe not quite there in terms of robustness, but close, at a significantly reduced cost, at least in the training side. So very interesting in how they are taking a new approach that appears to be relatively efficient into the training side.
Evan, I just had a quick question on when you read all the reports, and I'm no AI expert, I'm not in the weeds of it like you are. For me, I see two things though as an investment-minded person. There's the reduced cost to create the AI, but there's also a quicker speed to market. Which is the bigger concern, or are both concerns for the hyperscalers? What's your take?
Yeah, so I think it's interesting when you look at both, and I don't know if we fully know this speed to market, but the cost and the speed we're seeing is, first of all, there's just varying reports. And so, if we take for a moment for granted, which there's some ambiguity to it, right, that they are getting the efficiency in terms of the cost reduction, speed to market, paper reports, you're seeing a change in the efficiency curve. And so what you could see is that for, X unit of input, right, token, whatever you're spending right now, you're getting Y out. And so with this new model, if you're able to put in, 100 X, and previously you were getting 100 Y out, now you're getting 200 Y out. I think it's not clear, one, how this handles with scaling resources. So if instead of, 100 of the chips that they were using, the Hopper chips, or based on that architecture, they're using the Blackwell chips, or if they double the amount of input, right? What happens? Does it scale? Is it going to increase the output capacity, or is it reaching a plateau? We don't quite know that yet. But what we're not seeing is equivalence that, adding more resources is not going to produce a greater output. And so if we think about an efficiency curve that just shifted up, if you're a hyperscaler and you were investing $80 billion a week ago, if you're investing $80 billion today, it's possible that given a new approach, now you see 2-3 times the output, which would be, quite frankly, fantastic in terms of an ROI or use case, as well as just broadening the aperture for companies that now can justify investing more in AI and using GPU resources.
Evan, let me follow up on that, because the immediate reaction that we're seeing on these developments is that some of the poster children for AI, NVIDIA, for example, and others on the hardware chip side are really taking it on the chin. But at the same time, we're seeing other companies out there, software companies in particular, that could benefit from perhaps a quicker pace of adoption of AI, really start to rise on this news. And does that kind of support what you're thinking?
So I think absolutely. If you look at the SaaS companies that are doing well this morning after this news, or presumably on the idea, right, they're going to be able to adopt this technology better, the ROI and business cases may be more attractive. I think that supports an idea that you're broadening the aperture of companies that are able to invest in this. When you look at the chipset and the GPU structure, I think Mark probably talked about this as well, but if you look at recent announcements that have come out in terms of CapEx spending, it's not clear that we should expect to see a slowdown from any means from these hyperscalers in terms of CapEx. So whether or not, the specific chip from NVIDIA, if the next model is impacted by this type of training structure or the architecture, I think that is something we'll see as more and more evidence and information comes out about the new model. But from the underlying CapEx spend, I think we've seen some pretty good indication over the last week that it's slated to continue increasing.
So I take it with that, Evan, you're referring to the Stargate announcement, Meta talking about a significant increase in CapEx for 2025 compared to 2024. And I actually agree with you on this. I'm actually looking forward to the comments that we'll get this week and next from other big tech companies, Microsoft, Amazon, and others out there, just to see if this AI arms race on spending is continuing to accelerate.
I would just add on to that. My question is ROI. What is a good ROI on these investments then? What was it before, and what do you think it goes to now?
I think we think about this in two ways. One is current. And so if you look at announcements and earnings calls from some of the hyperscalers recently, you are seeing more and more of a focus and more tangible examples of companies that are able to use these AI and LLM models in order to generate real cost savings or value, right? So if you think about the way that a company could structure an algorithm internally in order to get value out, especially for advertisers, right? You're seeing value come in from the revenue side, but you're also seeing more and more examples of cost reduction. Then on the flip side of this, and I think this goes back to where we talk about from spending and maybe just a shift of the efficiency curve, is you're essentially seeing kind of an arms race in, so to speak. You want to spend to have the best model because the future possibility of this technology is so significant. And so it's not clear right now that companies are spending to get to a specific milestone. They're not looking to run a 100-yard dash and stop at 100 yards. They are looking to see how quickly can they accelerate and to whatever kind of the end conclusion might be, but it's likely not a short-term end conclusion. And so even if you have a change in what the models are outputting, that's fantastic. You have a better use case, better ROI standpoint. But if you're spending in order to have the best technology, to be a market leader and to not get left behind, that's not necessarily going to shift, even if kind of the underlying architecture is improved or updates or there's a new version of that.
Let me step back a little bit and bring Mark into the conversation. I have been familiar with SuRo Capital in the past with a number of the portfolio companies, but I believe, Mark, that over the last several quarters, you guys have really shifted around your portfolio. You've made several investments in AI, including OpenAI, CoreWeave, and I believe one or two others. If you could give us the perspective you had, what led to this shift, and do you see more of it happening in terms of the portfolio? In other words, are you going to continue to lean into AI and other disruptive technologies?
Thank you. Before I get to that, the one, I guess I'll reaffirm your commentary about Meta announcing an increase in their spend where Microsoft is, and the Stargate announcement earlier last week. Given that DeepSeek has been out and around since end of December, it's not a real surprise to all these huge companies of what was going on. And they have made this increased commitment to expenditures in light of that. So it's news to maybe a broader audience, but not to those that do, if you will. And the idea of the president, second day in office, standing in front of everybody with Oracle and SoftBank and OpenAI and saying there's a $500 billion commitment that OpenAI is going to run that whole process, if you will, to keep everything US based, et cetera. That's a massive commitment on top of all the others. This seems like a surprise in the sense that, oh, wow, look what's out there. But all the folks that were planning to spend money knew this was out there, still planning to spend money. So the end result of this will be what the end result was, but it isn't out of left field that people woke up and said, oh, wow, look what exists.
Mark, not that we're conspiracy theorists or anything like that, but is it possible that ahead of a February 1st conversation about tariffs, that this could be a little saber rattling, just given the timing of it all and given what you said about the Stargate announcement last week?
I'll flip it the other way and say that it was an important enough announcement, and it's so meaningful, size and scale and importance, that to make that announcement as big as it was at the time that it was on every major news channel, it's just an important announcement to be made. And it really speaks to the importance of AI infrastructure. And that'll bring back to your question. So I wanted to lead to that. We've been around since 2012, published in 2012. So a lot has changed. We have owned every name that you could figure we would have owned over the years: Facebook, Twitter, Dropbox, Spotify, Snap, Lyft, Palantir, Coursera, a litany of really interesting names. And we enjoyed a great run-up, as did the market, through 20 to 2021. We decided at that point in time the market was a bit extended, and we started to liquidate a vast majority of our portfolio, and did so. And we ended up paying out about $250 million of dividends to our investors. And then we sat still. And we came to the conclusion that the disconnect between the public markets and private markets was pretty severe. Private markets had not nearly come down as far as the public markets. And it was a time to just take a breath and see where the puck was heading, if you will, to make a determination how best to deploy capital. We deployed a little bit of capital in 2023. And then in 2024, we made a couple of decisions. I would say the most amazing, been around quite a long time, phenomenon that I saw was the supply-demand imbalance on need for compute and the availability of compute. And I've been trying to rack my brain to see where I've ever seen something that was, this can't be true because it's so obviously disconnected. Doing all the work, we came to the conclusion, and that others did, that there's going to be massive spends and massive amounts of money in AI. In the first place you go is picks and shovels and the infrastructure. And that's what we did. So we identified CoreWeave. We actually identified all of them about the same time, but to actually access the social period of time, accessing private security is challenging. Accessing at the right price. But we identified CoreWeave and said, given where they are, where their contracts were, where their customers were, what the demand was, and the growth rate where they were coming from, it seemed like there would have to be something that would massively change in order for that not to work. And that's why CoreWeave is probably the most anticipated IPO of 2025. But when we invested in it, even the analysts that cover us didn't know who CoreWeave was. And so CoreWeave, really, really exciting. the growth curve is, it's one thing when you see growth charts that show these massive growth curves by projections, and then there's others when they're actually contractual projections. And so that's what we saw at CoreWeave. That one, very excited about, committee. That's the largest investment we've ever made in the 13 years as a fund, as one company. OpenAI, I think, speaks for itself. Clearly market leader, continues to be the market leader, is the reason when you see Stargate and they say, and OpenAI is managing the whole thing. OpenAI is pretty much a must own if you want to be in the infrastructure space and in AI in general. And then in VAST, probably a name that not many people know, but it is, like, you will know the data is accessed, managed, utilized for training in AI. It is better than what's out there by a lot. They have core relationships with NVIDIA and others. And if we come back and talk 6 months from now, say, oh, wow, thank you for telling us about VAST. So we went and we committed about a third of our portfolio into these names. Really super excited about those. And as you mentioned, we have a couple of consumer names. I'll give you one that it took all of us a bit of time to get our arms around, but super exciting, is Liquid Death.
I knew it, Mark. I saw it in the deck. I knew you were going to bring it up. And I got to tell you, it's a great name and I enjoy the product.
Excellent. We do too. And it was about the longest debate we've had as an investment committee to decide to do it. Because if you just say it's water in a can, well, it sort of is water in a can. Now it's not just water in a can. Now it's flavored sparkling teas, and now healthy sodas and all that. But it's a brand, and their branding is amazing. Their growth is incredible. They did over $300 million in sales last year. They're growing super, super fast. They had about $1.5 billion valuation a year ago, and it'll be a public company in the next 12 to 15 months. So very exciting. People who knew the name were excited that we owned it, and that was one of our names we had recently. And finally is Canva. So no one on Wall Street knows what Canva is because they all know what PowerPoint is, but everybody else in the world knows what Canva is. It doesn't really know what PowerPoint is. So Canva has really benefited from using AI tools in their product and continues to do so. They now are doing $2.5 billion in annualized sales. They have 220 million active users. They recently did a round of financing at $32 billion. That was up from a prior secondary round, 20% lower than that. I think that's another company that is setting up to go public, whether it's end of this year, beginning of next year. They're very communicative about the finance. So yeah, we went into this year with probably close to 50% of our portfolio in cash because we wanted to find the right places, right time. We felt thematically AI, specifically the infrastructure and the base side of AI as opposed to some of the applications made the most sense for us right now. Committed a lot of money in that. And then we have a couple of the consumer names. The other name we no longer had, was we did own Oklo, which was a Sam Altman company, a small modular nuclear reactor company. We made 20 times our money. We sold it. And we don't really own public companies, but we had that from a private investment that went public. But that also is clearly benefiting from the energy, not only the existing energy needs to drive data centers, but the perceived ongoing energy needs and how that's going to be solved.
Yeah, no, we've been looking at that over at the Street Pro portfolio on the nuclear side. And I think you're right. We're also seeing other investments. I think Blackstone talked about acquiring some capacity. Microsoft is making some deals, and I think it's Fire Island in New York is starting to move closer to refire. I agree with you that just given the explosion in data consumption, data creation that we're going to have as a result of AI, the power requirements, this entire digital infrastructure is going to benefit. It's not just AI chips. I think network infrastructure is going to have to be upgraded and improved, and just all down the line. So I think where your position is extremely smart. I guess my question to you, Mark, is you mentioned a couple eventual IPOs. Just given how you guys work, investing in private companies, you do need to monetize at a certain point. But does it have to be IPOs, or are you guys just as happy with M&A activity taking some of your positions out?
That's a great question, because private markets are complicated. There's proven opacity in pricing, and just the ease of entry and exit is challenging. It just is. Over the years, we've exited in the following ways. We have had, obviously, IPOs. There's been M&A activity in and around a fair amount of our portfolio. We've sold back into the private markets. So not only bought through the private markets, sold back in through the private markets. Obviously, during the SPAC craze, we probably have 4 or 5 companies go public through that as well. So we have a lot of different ways to exit our portfolio. I think the private market activity has grown quite a bit. So the liquidity in those markets, especially bigger names, is pretty strong. If we wanted to sell some of the names we just recently talked about, there's private market bids for all of them. If we chose to do that, we just bought. So the last thing we're really interested in is turning around and selling to the private markets. But IPO is clearly a one. And the M&A side will take care of itself through those companies. We won't have any real influence in driving M&A activity, but there will be M&A activity in a bunch of the spaces that we're in. So would be surprised if some of our companies end up bought rather than going public either through a traditional or non-traditional route.
So do you have a target or average turnover in your portfolios then? It seems like you're really patient with the opportunities that you invest in. You do your due diligence and kind of wait it out. Do you have an average turnover?
Good question. First of all, we're clearly rifle shots, not shotgun approach. We spend a fair amount of time determining what we want to buy. In the later stage investments, we assume that our turnover is somewhere between 18 and 36 months would be on the outside. So the pre-IPO names, if you will. Most of the names, if we buy them pre-IPO, and we didn't talk about Service Titan, we did own Service Titan. We knew that was going to be an IPO sometime last year. When we bought it, we were right. The market liked it, which is great. It was the first one out of the box. But that almost hit our timeline within a few months. For almost any company that IPOs, there's a lockup period that we have after the IPO. Unless it's a direct listing, the lockup period is typically 6 months after the company goes public. So on the later stage, 18 months to 36 months. Some of the earlier stage can be a bit longer, but we don't have a timeline that's 5 to 7 years out. We're much closer to later pre-IPO investing than really early seed, 5 to 7 years. Hope that works.
You know what I like about this conversation we're having, as I think about your investment style, the areas that you're focused in on, they're topical, but it also means that, just like most investors, you guys really have to have your finger on the pulse of what's happening. And I think that as we go forward with our podcast, talking to you guys from time to time would be very insightful, not only to us, but really to the audience that we have and other investors out there. So I want to say to both of you, Mark and Evan, thank you, so much for coming on and really helping give us some much needed perspective on what's happening on the AI front today. Very timely, very helpful. But I also think, though, too, that the opportunity with SuRo Capital and its shares for investors that are looking for ways to participate in what's coming, I think that is as interesting. And with that, I would just ask, Mark, where can folks go to learn more about SuRo Capital?
Start with send an email through our IR site. I believe a couple of things. Our jobs was invest the money well, value our portfolio accurately so you know how to value it when you buy it, and communicate our story clearly. So I've gotten on the phone with small investors, institutional investors. I'm happy to take phone calls to discuss what we're doing, to help people understand our story. We're proud of our story. We are really the way to participate in the private markets with a public vehicle that has public liquidity, that is reasonably priced, that really we spend time and effort to communicate it. We have analyst coverage, and our valuation process is extremely robust. And we're happy to tell the story if people want to learn more about it. Of course, we have a website. Go to the website if they want. Really communicative on our earnings calls. We do them 4 times a year. Unlike some other closed-end funds don't have to. We're BDC, we report quarterly. We have extensive earnings calls. We do have analyst coverage. 4 firms cover us, so there's plenty of research on us. But if they want it from us directly, they should feel free to reach out to us.
Awesome. We look forward to having you guys back in the next couple of months, even if it's only to talk about the eventual CoreWeave IPO, but I suspect it'll be another great conversation. So thank you very much, gentlemen. All right, folks, that I think was a great conversation with Mark and Evan. Lindsey, what did you think?
I thought it was excellent. It certainly calmed the fears that I had about rising competition and uncertainty in the AI space and how to invest in it. But I also thought it was really revealing and a reminder to investors that the investments that are being made in CapEx, you can't get hung up on the ROI. And I know those are dangerous words, right? Back to the dot-com bubble. But you have to spend to create efficiency, and you have to spend to be a part of the game, because it is an arms race. And so, I don't know, it was just a refreshing or interesting differentiated perspective. What did you think?
Well, to me, the point that Mark made was that this has been known to people who have been really focused on the industry, people who are deep in the weeds. It's only when it makes mainstream headlines, let's call it, does it kind of percolate across Wall Street's desk, right? And, it just reminds me of times that, you and I see certain things in data. We have a pretty good idea of what's coming, but it's only when everybody else sees it, right, that you get the reaction, right? The big mainstream reaction. And sometimes that's appropriate, sometimes it's not. And I think if we play this out with what we're seeing regarding DeepSeek, maybe it is overdone.
Yeah, I think that's the name of the game with investing, right? It's finding these opportunities, learning as much as you can ahead of time, but also taking a deep breath when big reactions like this happen, and, taking the time to realize, is this a buying opportunity or is this something worse? And so I think that's what investing's all about.
I agree. It's also looking for confirmation. And I think we're going to have a lot of confirmation in the next 2 weeks as the rest of big tech reports. That's going to be Microsoft. That will be Meta, probably fleshing out a little bit more on their capital spending plans, but also Alphabet, Amazon, and others. So it's going to be a big set of weeks, folks. I would encourage you to come back and listen to Lindsey and I break it all down. But if you need Lindsey or myself between now and the next What Does It Mean podcast, march on over to LinkedIn for Lindsey's comments, and you can always find me at The Street Pro. Thanks for listening.